You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, we've got Aaron Rubin with us, who specializes in tax and stock options. Aaron is a CPA and an attorney, although, like me, not practicing. So kudos to you there. Hey, tell us, all these tax things. Recently, we heard about Elon Musk, and he had a large position of options in Tesla coming up that he had to execute. So he basically sold off a huge chunk of stock and then exercised the options. I didn't realize that when you actually exercised an option, it could be a taxable event.
Yeah, it absolutely can. And my guess is because Elon Musk is as smart as Elon Musk is. He was probably sitting on some incentive stock options, which have a little bit of a different feel to them, where you can exercise the options and it does get taxed. It's a preference item on your alternative minimum tax, and it's a little bit of a complicated dance to do on your tax return. But again, if you're going to be exercising a lot of stock somewhere else, or if you're going to be, or if you have a lot of other income, with like Elon Musk does. When you go to exercise those options, sometimes it makes sense to sell something else. So yeah, absolutely. It stinks, right? Because you don't think that you're going to need money to buy something for tax, but you do.
Yeah, well, according to Elon Musk, his taxes are so simple that he could go to H&R Block and have them do his return. You buying that?
No, I would. If Elon is going to H&R Block, I recommend he come to WRP Tax. He might get some better planning advice there. I know people who've taken the H&R Block course, and no knock on H&R Block. I mean, my guess is that 90% of the U.S. population could use H&R Block, but there's a chunk that shouldn't. And my guess is he's in that chunk pretty solidly.
Yeah, I would say. I've known people that have gone to H&R Block, and I guess if you have a plain vanilla, you're a wage earner, limited deductions and all that, and limited tax options probably makes sense. But maybe Musk should go to Hewlett Tax. Right?
Yeah, well, and not just H&R Block, but usually, your standard, do it at home. Is usually okay. It's amazing to me though how many times I catch errors from the H&R Blocks of the world, because clients come to me, or prospects will come to me and they'll show me their tax return, and I'll say, this isn't actually done correctly, and they have to go back and amend. So again, better to catch it now than to live with the consequences later.
Yeah, I couldn't agree with you more. I've always used a CPA or an accountant to do my taxes. One time I filled out a return myself, and I swore never again. But really, so you get in this situation. You got incentive stock options, and then when you actually exercise them, the government considers it to be a taxable event, and profit is due upon execution. So how do you help people minimize this tax bite?
Yeah, so some of it depends. So sometimes it requires a lot of forward thinking. And so a lot of times our clients will come to us and they'll have either they're going to sell stock on the secondary market if it's not liquid stock, or they will have a tender offer at their work, meaning that somebody's going to come in, they want to buy shares through the employer. And so, they'll recognize, gain of $2, $3, $10 million, whatever it is. And if, depending on what kind of stock they're selling, and a lot of times, it'll be, what's called non-qualified stock, and non-qualified stock, the difference essentially just goes on your tax return. And so they'll sell a lot of these tax return, your W-2, it goes in your W-2. And because it's a wage, it gets taxed at normal, tax rates. And so it it actually increases your ability to exercise incentive stock options for no tax at all. So again, because it's a little bit of a delicate dance there. Again, this is why Elon Musk should not be going to H&R Block. You have to think about when you have an opportunity to sell stock, what stock do you choose to sell? And if you're selling stock that ends up in your W-2 or buying stock that ends up in your W-2, that's an opportunity to go back on your incentive stock options and claim some of those for no tax at all. So again, it's and I don't want to get too much in the weeds in the 15 minutes we got, but again, a lot of that planning requires some forethought.
Okay, so I guess the question is, like, how do you plan this stuff out? What's the best way to do this?
Well, working with a CPA who knows what they're doing is a good first step. Whenever a client comes to me and says, "Hey, I'm switching jobs," and I just got all this stock, the first question is, well, okay, can you early exercise the stock? And that gives you opportunity to buy stock for, again, no tax consequence. Again, there are definite, speed bumps in there, when you're doing an early exercise, but again, it requires a lot of forethought. So again, whenever there's an opportunity, you're switching jobs, you're leaving a job. You had a really, again, for a lot of the salespeople, we work with, they have a really big quarter or a big few quarters, and all of a sudden their income spikes up. Again, when something out of the ordinary happens, chances are there's an opportunity buried in there to really, get some good tax footing in relation to either incentive stock options or possibly even non-qualified stock options.
All right. Hey, so I assume you do other things besides stock options. Tell us more about other tax minimization strategies you might have.
Yeah. So again, this is when working with a professional makes a lot of sense. Is when you have these sort of liquidity events, and so we have clients that were at Coinbase and had huge days when it first came out on its direct listing, and thankfully they sold 80% of what they had, but you're right, it creates a huge tax problem. So what do? You start thinking through, how do we kill two birds with one stone, right? So a lot of our clients, especially when you start, talking about $20-30 million, worth of liquidity, start thinking about charities a lot more, and really making an impact. And so if someone is charitably inclined, there's so much opportunity out there on a post liquidity event to minimize tax. So the client that I spoke to that had a big Coinbase day, we created a foundation for them, and we created a charitable trust to work around some tax loss harvesting issues, and so again we end up again minimizing the tax because we got a huge tax deduction by using the foundation paired with the charitable trust, and then along the way, as we were investing them, we were putting them into vehicles which would generate some tax losses on their return for capital loss purposes, and again, hopefully erase some tax down the line on top. So again, it's whether it's pre-liquidity, post-liquidity, again, there are opportunities everywhere depending on the size of the event, and if the person is charitably inclined.
All right. So, hey, about Elon Musk, he also had a charitable foundation I was reading, which I wasn't aware of. So how does he work that with the options to wind up paying less tax?
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project, with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah. So again, part of it depends on, what kind of option we're talking about. So if he, hypothetically, again, I don't know what he did. I don't know what options he had. If he exercised, I don't know. Well, he exercises, hundreds of millions of dollars at a time. But let's say he sold $100 million worth of his stock, of Tesla stock. The strike price was pennies, which is probably what it was. He turns around and he's this enormous gain on his W-2. Because whether or not you're the CEO or whether you're the janitor, non-qualified works the same. This huge gain goes on his W-2. That increases his adjusted gross income. He can turn around and take that cash, put it into some charitable vehicle. It could be his own foundation, could be a charitable trust, whatever it might be. If he gives it, whatever he gives to the charities in cash, he gets a deduction for. And again, they change the rules so often on this stuff. It's hard. Sometimes it's hard for me to keep up. I think the rule is 60%. Nowadays, you can deduct 60% of charitable charitable donations, in terms of your AGI, if it's going to a public charity. If it's a private foundation, different rules apply. But that's how you do it. I mean, so you exercise these options, you same day sale them. There's zero capital gain because you already got taxed on the exercise. And to get rid of that tax, you turn around and use your foundation or another charitable vehicle.
Right. Okay. So about that with private foundations, what's the difference there? If you could just
some big differences, in terms of your deductibility on your tax return. So public charities, you get the kind of the best bang for your buck, or if you use a donor advised fund associated with a charity. And usually, again, it's either 60, 50% somewhere in there. If it's a private foundation, if it's cash or a non-appreciated asset, I'm nearly certain you're at about 30% of your AGI. So again, there are limitations in there. If for some reason you run up against your limitations, which happens, although you should be planning for that, you can carry forward a few years and use what you weren't able to deduct in the prior year. But yeah, charitable foundations, especially private foundations, have their own set of rules. And if you're using appreciated stock, it's even worse.
It's even worse, huh? They got you coming, they got you going. Well,
the government's going to get paid.
I know people want to find out more about what you do, Aaron, want to connect with you on the web. Where is the best place to find you these days?
Best is our website, wrpwealth.com, and you can schedule an appointment online if you want to and chat for a few minutes. Of course, you can always find us on Twitter and Facebook, but the website's probably the best thing for your buck. And we have blogs and all sorts of interesting stuff.
Hey, so one thing, when you are signing up for this, when you're planning this, when you know you're going to be getting stock, what are the three things you should do to minimize that eventual tax burden? So
to me, the biggest thing is being able to early exercise your stock options. So usually what happens is, you're given a 4-year vest, 1-year cliff. So, basically what that means is that you can only exercise your options starting after you've completed a year of service. And at that point, it's 25%. Is what you can exercise of what you were granted. And then usually monthly vest or maybe quarterly vest thereafter. What an early exercise does is it says, okay, even though technically you cannot buy the stock, you can pre-purchase the stock. So it's not yours until it vests, but you can give them the money to essentially make it yours on paper. Right. And the benefit to that is that when you get granted your stock options, the strike price and the fair market value are the same, typically when you get them. And what you get to do on an early exercise is you get to file what's called an 83B election with the IRS. And what an 83B election does is it tells the IRS, I want you to tax me on this, even though I technically don't have to be taxed, right? And so because the tax is based upon the delta between the strike price and the fair market value, you get tax zero in the beginning. So no matter how well your company does in the future, as that stock vests, you don't owe additional tax. Mm-hmm. It's an incredibly powerful tool, for people getting stock options. The second thing I'd say is, if you're at a smaller company, be cognizant of whether or not you think you have qualified small business stock. And qualified small business stock, essentially, and I'm not getting into the weeds, it's a very complicated part of the tax code, and there's lots of nuance. But essentially, if you hold a small stock, which is defined as a company that has less than $50 million in assets when you acquire the stock, and it's a U.S. C Corp, and you hold the stock for 5 years, right, you get $10 million of gain that's excluded from your income. So it's a huge tool. And not only that, you can actually transfer the stock to different people or to different trusts to multiply that $10 million. So if you create, 9 trusts plus yourself, you have 10 different entities, you can get $100 million of stock, essentially tax-free from the federal government. If you're in California, they don't give a crap. They're going to take your money. There's no such thing as qualified small business stock in California.
Is it good? And then, get out.
What's that? Yeah, right. Immediately head to Nevada. That's the trick.
So you're going to get a windfall. Leave California, the People's Republic, immediately.
Yes, right. You do that well, yeah, and don't leave too late because California will sink its hooks into you early on. Maybe that's my third one: is that know your state tax laws.
And leave California. Leave California. Above all, if you're in California, get the heck out.
Yeah, well, again, we've had a lot of clients leave, and what you should know is that if you leave California in the middle of a vesting, or if you've vested, even if you haven't purchased stock, if the stock is vested while you're in California, California will still lay claim to whatever happens to that stock down the line. Not on disposition, but on acquisition. So, we've had clients say, "Oh, well, I've been in California for 4 years. I'm fully vested, and I want to move. I haven't exercised the thing yet. I'm going to move to Nevada." It's like, well, that's great, but that's not going to save your soul because California's going to say, as soon as you buy that stock, that was earned in California. California's going to claim that on their tax return. That you should be paying that, even if you're different, even if you're a resident someplace else. So, it's be cognizant of that.
Gotcha. All right. Really fascinating, little arcane, portion of the law. And hey, if you got a question for Aaron, shoot me an email, kl@kerrylutz.com. You can go over to the site, financialsurvivalnetwork.com, click the link in the show notes, take you right to Aaron's site. And while you're there, sign up for a free newsletter. Aaron, a pleasure. Thanks so much for stopping by.
Oh, thanks for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.